All right, let's get right into it. Over the last couple of years, something really interesting has been happening inside Tesla's financial statements. Now, on the surface, it looks like a simple growth story, but if you dig just a little deeper, you'll see this great divergence taking place. It's a massive strategic pivot, really, hiding in plain sight, with one part of the business funding the other to create something completely new. So here's the bottom line. The net income you see in the headlines, it's becoming a mirage. It's actually masking a severe, and I mean almost startling, collapse in the profitability of what we all thought Tesla's core business was. Selling cars. Understanding the split is absolutely the key to figuring out what this company is really becoming. And this chart really lays it all out. On one hand, you've got the backward-looking story, a huge $12.6 billion in net income for 2022. Impressive. But look to the right. In just 1 year, from the third quarter of 2022 to the third quarter of 2023, the automotive gross margin, that's the profit on each car before overhead, it absolutely plummeted. We're talking from a world-class 27.9% all the way down to 16.3%. That's not a dip, folks. That's a free fall. It's severe margin compression, and it signals a real crisis in the hardware business. Now, a margin collapse like that doesn't just happen in a vacuum. No, it creates what I can only describe as a financial air pocket. This is a period of just extreme operational stress, where the basic economics of the car business really start to fall apart. So what's the first sign of trouble? You look at the inventory. A 31% jump in finished cars in just 9 months. Now, that is not a company getting ready for a sales boom. That is the classic red flag of a supply and demand imbalance. Simply put, they were building cars a whole lot faster than they were selling them, and those cars were just piling up. And here's the direct result of that. When your margins are collapsing and your inventory is soaring, the cash machine just starts to sputter. Operating cash flow for the year dropped by 22%. All of a sudden, the company was generating way less cash from its main gig, building and selling cars. And that is the air pocket. It's that terrifying moment for a high-growth manufacturer when negative operating leverage really takes hold. You see, all those massive, expensive factories that used to drive incredible profits, they're now working in reverse, just amplifying the financial damage of every single unsold car and every point of lost margin. So if the core car business is hitting an air pocket, how does the company even survive, let alone fund its future? Well, the answer isn't in the auto business at all. It's in a completely different division that has been quietly becoming this high-margin lifeline. This is the whole divergence story on one slide. On the left, you've got automotive, slowing growth, that brutal margin compression we talked about. But then you look to the right, at the energy segment, and it's a completely different universe. Growth is exploding at 40% year over year, and the margins have seen this massive expansion, jumping from 9.3% to 24.4%. It's incredible. And that 24.4% margin, that number is everything. The energy business, especially those big megapack batteries, is now way more profitable than the car business. It's become the financial bridge, is generating the high-margin cash needed to offset the auto decline, and, this is the important part, to fund whatever comes next. Which brings us to the verdict. So where is all this cash going? It's not just about surviving a downturn in the car business. No, it's about funding one of the most ambitious and capital-intensive pivots in modern corporate history. And you don't have to guess. The company tells you right in their filings. They're planning for capital expenditures of $7 to $9 billion a year. Let's be clear, that isn't just for maintenance. That's a war chest for building new factories, new infrastructure, and the absolutely massive computing power they need for their ultimate goal. And then you have the R&D spending, an annualized run rate of about $4.6 billion. This kind of money isn't going into designing better cup holders. We are talking about full self-driving, the Dojo supercomputer, the Optimus robot. This is a full-scale, all-in investment in artificial intelligence. So here it is, the new financial model laid bare. Step 1, the automotive hardware business, with its declining margins, is kind of becoming a legacy operation. Step 2, the energy storage business is the new cash engine. And step 3, that cash is being immediately redeployed into a multi-billion-dollar bet. Step 4, a fundamental pivot from being just a car company into a full-stack AI and robotics company. And that leaves us with the critical question that every investor has to ask themselves now. When you're buying into Tesla, what are you actually buying? Is it a car company that's just going through a rough cyclical downturn? Or are you, through your investment, actually funding one of the largest, most ambitious, and capital-intensive AI research labs in the world? The answer to that question really changes everything.